Have you ever watched a winning trade turn into a disaster just because you didn't have a plan? That single moment destroys more traders than any bear market. I saw it happen in 2020. A trader I worked with bought Zoom right as the world shut down. The stock doubled, then tripled. His account was glowing green. He told me, "This is the trade that changes everything." But here's the catch. When Zoom dipped just 10%, fear kicked in. He sold early, locked in crumbs, and watched as the stock kept climbing another 100% without him. He promised he'd be smarter next time. But the very next month, he piled into another hot name, even bigger. This one pulled back harder. Instead of cutting his loss, he froze. He whispered to himself, "It'll bounce." It didn't. His Zoom profit was gone, replaced with a loss so heavy it sidelined him for months. This is the cycle that crushes the average trader. They don't fail because they can't find a winner. They fail because they don't know how to hold one or cut one when it turns against them. And that's exactly what we're going to break down today. The playbook of the world's top momentum traders. How they size up, cut fast, and ride waves longer than most people think possible. Here's what you'll walk away with if you stick with me. How to think risk first, the mental shift that saved me from blowing up more than once. Why concentration, not diversification, is the secret to real momentum gains. And the simple rule that will stop you from turning a green trade red ever again. By the end, you'll know the mindset shifts that separate the masters from everyone else and how to use them to trade with calm confidence instead of chaos. That story isn't rare. It's one I've seen play out hundreds of times. And it's why this channel exists. My name is Ben and welcome to Zenstock, where trading meets clarity. Here we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath. Clear your mind. For the next few minutes, give your trading psychology your full attention. And if you find value in this message, make sure to like this video and subscribe. It helps more traders discover tools that can change the way they trade. To frame today's lesson, I want to bring in the voices of some of the greatest momentum traders alive. The book, Momentum Masters. A roundtable interview with super traders brings together Mark Minervini, David Ryan, Dan Zanger, and Mark Ritchie II. Traders who've each built legendary track records by mastering the psychology and discipline behind momentum. Their insights shaped how I trade and how I coach others. And what they reveal isn't just about patterns or price action, it's about mindset. Because mindset is what keeps you in the game long enough to capture the kind of runs that can change your entire career. Early in my career, I thought the hardest part of trading was finding the right stock. Screens, chart scans, news flow, I poured hours into all of it. And then I finally caught one. It was 2013. Tesla was breaking out in a way I had never seen before. I bought in, felt the rush of being in the right trade, and promised myself I'd hold for the long move. But here's the problem. I kept staring at the 5-minute chart. Every wiggle looked like danger. Every red candle felt like a threat. Within days, I panicked out with a tiny gain. And you can guess what happened next. Tesla doubled, then tripled. I sat there watching, sick to my stomach, realizing the big money had slipped through my hands, not because I didn't know what to buy, but because I didn't know how to hold it. That wasn't the last time either. I'd enter a trade with conviction, but then I'd get shaken out by noise, regret selling too soon, and chase back in at higher prices. The pattern repeated, draining not just my account, but my confidence. It took years, and a lot of painful repetition, before I realized what David Ryan, one of the masters, was talking about when he said his biggest winners came from holding for the intermediate to long term. He admitted he too had been shaken out early when watching short-term charts, but the real wealth came from letting the big move unfold. When I finally stopped obsessing over the tick by tick, when I forced myself to step back and focus on the larger trend, everything changed. My winners got bigger, my confidence steadied, and I began to see that trading wasn't about chasing excitement. It was about managing my own psychology long enough to let the market reward me. That lesson reshaped my entire approach. And it's the perfect place to start today's deep dive, because every single master agrees on this point. The first key to momentum trading isn't entry, it's how you think about risk and discipline once you're in. That story taught me something simple but hard to live by. Momentum trading isn't about finding the perfect stock, it's about how you manage yourself once you're in. And that's the heart of today's talk. We're breaking down the psychology that separates average traders from the masters: discipline, risk, and clarity. Not hot tips, not predictions, but the mindset and methods that keep you in control when the market tests you the most. This is where trading psychology meets strategy. Because every chart pattern and every breakout only matters if your psychology doesn't sabotage you first. Quick disclaimer, none of this is financial advice. It's for education and entertainment only. Always do your own research before trading. Now let's dive into the first principle. And it's one that every master trader repeats again and again: think risk first. The first rule of momentum trading isn't about what to buy, it's about what you're willing to lose. Minervini put it bluntly: always trade with a stop loss and know where you're getting out before you get in. That's his number one rule. And it's not just a technical rule, it's a psychological shield. I had to learn that the hard way. Back in 2015, I put nearly a quarter of my account into a biotech stock right before earnings. No stop, just conviction. When the company missed expectations, the stock gapped down overnight. By the open, I was staring at a 30% loss on one position. That single mistake wiped out months of slow, careful gains. The trap I fell into was loss aversion, the brain's natural tendency to avoid pain at all costs. Kahneman and Tversky's research on prospect theory showed that we feel losses about twice as strongly as equivalent gains. That's why traders freeze. That's why they say, it'll come back. Because selling at a loss feels like admitting failure. But here's the paradox: refusing to take a small loss guarantees you'll face bigger ones. That's why Minervini caps risk at no more than 2.5% of total equity on any trade. David Ryan is even stricter. He risks just 1%. Their discipline isn't about predicting the future. It's about surviving long enough to be around when the big winners appear. And this is where most retail traders break. They focus on entries, on finding the next Tesla, but ignore the exit plan. They enter without asking the only question that matters: where am I wrong? When I mentor new traders, I tell them this: write your stop before you write your entry price. If you can't accept the risk, you don't deserve the trade. Risk isn't exciting. It doesn't make headlines. But it's the foundation every momentum master stands on. Without it, even the best breakout becomes a ticking time bomb. One of the biggest myths in trading is that diversification always protects you. It's true for long-term investing, but in momentum trading, spreading yourself too thin dilutes your edge. David Ryan explained it simply: he starts each position at about 10% of his portfolio, with no more than 10 stocks at a time. Minervini goes even further. If he finds a true leader, he'll press it to as much as 25%. Why? Because concentration forces clarity. You can't babysit 40 positions and expect to execute with discipline. When you limit yourself to a handful of stocks, every decision gets sharper. You know each chart inside and out. You know the fundamentals. And when something shifts, you can act instead of react. I once worked with a trader who held over 50 names at once. On paper, it looked diversified. In practice, it was chaos. He couldn't track earnings dates. Stops slipped. Winners went unnoticed because the laggards drained his focus. He called it spreading risk. But in reality, he was spreading attention, and attention is the most limited currency you have as a trader. The psychological trap here is overconfidence in false safety. Diversification feels safe because it looks like you're hedging. But in momentum trading, what you're really doing is hedging against your own conviction. You're telling yourself, I don't trust my system enough to press my edge. Behavioral finance research backs this up. A study by Barber and Odean 2001 found that individual investors who over-diversified and over-traded underperformed the market by about 6.5% per year. Not because they didn't pick winners, but because they watered down the impact of those winners. The masters flip that logic. They know that a handful of stocks, if managed with discipline, can transform a portfolio. Ryan himself said his best gains came when his portfolio was concentrated in fewer than 10 positions. I felt that shift when I trimmed my portfolio down from 20+ names to just 8. Suddenly, I wasn't chasing. I was waiting. I was ready to act decisively. And when a true leader broke out, I had enough capital in it for the win to matter. Concentration is uncomfortable. It makes your P&L swing more. But that discomfort is the price of clarity. And in momentum trading, clarity always beats comfort. Every trader has heard the cliché, cut your losers short and let your winners run. But few live by it. David Ryan didn't mince words. Your first loss is always your best loss. That line has saved me more than once. Because the longer you hold a loser, the harder it becomes to let it go. I remember a trade in 2017, a small cap tech stock I thought was the next big thing. I entered, it dipped a few percent, and instead of cutting, I told myself, it's just noise. A week later it was down 10%. I thought, it'll come back. At 20%, I stopped checking the chart daily, the pain was too sharp. By the time I finally sold, the loss was 40%. That one position set me back months. Why? Because I fell into the sunk cost fallacy. The more I invested, the more emotionally attached I became. Selling felt like admitting failure. Holding felt like giving the trade one more chance. The data shows this isn't just me. Terence O'Dean's famous 1998 study of over 10,000 brokerage accounts found that retail traders consistently sold winners too early and held losers too long. He called it the disposition effect. The result? Their portfolios lagged badly, not because they couldn't find winners, but because they couldn't let go of losers. Ryan flips that logic. He dumps laggards fast. The stocks he's losing on are the first to go when markets turn hostile. That frees up capital and attention for the leaders. And it means he never lets a red trade metastasize into a portfolio wound. Mark Minervini takes the same stance. If his stop is hit, he's out. Period. No just in case. No bargaining. Protect the account, protect the math. Here's the shift that changed me. I started seeing losses as business expenses, not personal failures. In any business, you pay for rent, marketing, equipment. In trading, you pay in small, controlled losses. That's the cost of doing business. And if you pay them on time, you avoid bankruptcy. The key is balance. Cutting losers is half the rule. The other half is letting winners run. Ryan admitted his biggest gains came from the stocks he held the longest. If you can combine both, exit losers quickly, and stay patient with winners, you unlock the asymmetric payoff of momentum. Today, whenever I'm tempted to just give it one more chance, I stop and ask, would I buy this stock right now, at this price? If the answer is no, I sell. That single question has saved me from dozens of disasters. Cutting losers fast isn't optional, it's survival. And it's what frees you to ride the rare, life-changing winners long enough for them to matter. Traders love complexity. The more indicators on the screen, the more it feels like control. But the masters don't play that game. David Ryan said it best. You don't really have to look for cut with handles, or saucers, or W formations. You just have to draw a line across the top of where most of the stock's trading has taken place. Then you buy as it moves through that line. That's it, a line and a breakout. Simple, clear, repeatable. I once coached a trader who had 8 indicators stacked on his chart. MACD, RSI, stochastics, Bollinger Bands, Fibonacci levels, the works. Every signal contradicted another. When he won, he credited the indicator that confirmed his bias. When he lost, he blamed the one that didn't. He wasn't trading, he was hunting for confirmation. That's the psychological trap. Confirmation bias disguised as sophistication. We trick ourselves into thinking more tools equal more certainty. In reality, we're just giving ourselves more excuses. Minervini takes the opposite approach. He uses price, volume, a few moving averages, and company fundamentals. That's it. Because complexity doesn't improve discipline, it distracts from it. Behavioral finance backs this up. Barber and O'Dean's 2000 study found that the most active traders, those who constantly sought signals and reasons to trade, underperformed less active traders by 6.5% annually. Complexity didn't lead to precision. It led to overtrading and worse results. Think about it like this. A pilot doesn't need 20 different dashboards screaming at once. They need the few critical gauges that keep the plane in the air. Trading is no different. I had my breakthrough when I stripped my charts down to price, volume, and one moving average. The noise vanished. Suddenly, I wasn't waiting for 5 signals to align. I was waiting for one clean setup. And when it came, I had the conviction to act. Simplicity doesn't mean easy. It takes discipline to ignore the endless indicators on social media or the latest secret pattern being sold. But trading isn't about looking smart, it's about making money. And the masters know, the simpler the system, the easier it is to stick to under pressure. When you're tempted to overload your charts, ask yourself, if I could only keep 3 tools, which ones truly help me make decisions? Cut the rest. Clarity is worth more than complexity. Because in momentum trading, simplicity isn't just elegance, it's survival. Every trader wants the magic setup, the perfect system, the one pattern that never fails. But here's the truth. The real edge isn't the system. It's your discipline to stick with it. Mark Minervini compared it to a marriage. Your relationship with your stock strategy is like a marriage. If you cheat on it, if you drift, you won't last. He's right. Most traders don't fail because their method is broken. They fail because they abandon it the moment it feels uncomfortable. I've lived that. In 2018, I had a rough streak, 4 losers in a row. I started doubting my process. I tinkered with new indicators, experimented with shorter timeframes, and even subscribed to someone else's signals. For a few weeks, my charts looked impressive, colorful, complex, full of new insights. But my account told the truth. I was bleeding money. The trap here is ego and emotional spillover. When life feels out of control, or when your identity gets tied to every trade, you grasp for something new. You tell yourself, if I just add this filter, if I just switch strategies, I'll avoid the pain. But what you're really doing is abandoning discipline. Here's the thing, markets go through seasons. Even the best systems underperform for stretches. That doesn't mean the system is broken. It means patience is required. Minervini said it plainly. He uses timeless principles based on supply and demand. Those don't stop working. They just go in and out of favor. Behavioral studies confirm this. Research on style drift in fund managers shows that when managers abandon their stated strategy after underperformance, returns often get worse, not better. Why? Because inconsistency destroys compounding. What turned me around was scaling down, not switching systems. I cut position sizes in half, gave myself breathing room, and forced myself to trade my process even in a cold streak. Slowly, the tide turned. And when the market aligned again, I was there, ready, consistent, and disciplined. Discipline doesn't just protect your capital, it protects your confidence. It gives you the ability to sit in cash when setups aren't there, and to press when they are. It keeps you from style drifting into a strategy you don't fully understand. And most of all, it lets you measure your results honestly. Because without discipline, you're not trading a system, you're just improvising with money. The masters don't let ego or emotion dictate their next move. They let discipline do it. And that's why they survive long enough to capture the kind of runs most traders only dream about. So here's the real takeaway. Your greatest trading edge isn't on the chart. It's in your ability to stay married to a process when every part of you wants to walk away. Now, let's talk about the pitfalls. The things that separate average traders from the masters, not because of intelligence or tools, but because of psychology. Mark Minervini laid out the biggest reasons traders fail. And when I look at every student I've coached, I see the same patterns play out. The first is not cutting losses. This is the single most common mistake. Traders convince themselves they're being patient, but really, they're avoiding pain. They'd rather let a loss linger than admit defeat. And that hesitation turns small cuts into gaping wounds. The second is adding to losers. This is the number one reason traders blow up. I've seen it countless times. A trader doubles down, thinking they're lowering the average cost. But what they're really doing is compounding their error. As Minervini put it, averaging down is portfolio suicide. The third is failing to protect profits. I once worked with a trader who watched a 30% gain evaporate into break-even because he wanted just a little more. He turned a career-changing win into nothing. The trap here is greed dressed up as patience. The masters know, never let a good gain turn into a loss. The fourth is style drift. Retail traders jump from strategy to strategy, chasing whatever worked for someone else last month. But every time you reset your system, you reset your learning curve. Discipline dies in the process. And finally, breakdowns in discipline. Even traders with written rules eventually break them in the heat of the moment. All it takes is one lapse in discipline to undo weeks, sometimes months, of progress. What's powerful here is that these aren't rare, complicated errors. They're everyday psychological traps. Overconfidence, loss aversion, ego. They creep in quietly and ruin accounts loudly. The masters avoid them, not because they're smarter, but because they're ruthlessly self-aware. They know the traps, they expect them, and they build systems that protect them from their own worst impulses. And that's exactly what you can do too. It's one thing to know the traps, it's another to have tools that keep you out of them. The masters don't just rely on willpower, they build structures that enforce discipline. Here are 2 simple but powerful rules you can use starting today. Rule 1. Write your stop before your entry. Before you buy a single share, decide where you're wrong. Put it on paper. Mark it on the chart. Commit to it. If you can't accept the loss, you don't deserve the trade. Minervini and Ryan both do this every time. Ryan's rule was clear. He risks no more than 1% of equity per trade. That's how he survived decades in the market. I tell new traders, your first decision isn't how much you'll make, it's how much you're willing to lose. Because in the market, survival comes before success. Rule 2. Move money from losers to winners. Ryan calls this one of his top 5 rules. When a trade isn't working, free up that capital and redirect it to the names that are. Don't babysit laggards. Don't let ego keep you stuck. Capital is oxygen, and winners deserve the air. I use a simple exercise to reinforce this. At the end of each week, I look at my portfolio and ask, if I had to build this from scratch today, would I keep this stock? If the answer is no, I sell it. That one ritual has kept me from holding dead money and helped me press into leaders with conviction. These rules sound basic, but that's the point. Complexity creates excuses. Simplicity creates execution. And execution, following your rules when it hurts most, is what separates the masters from everyone else. The market doesn't reward the smartest trader. It rewards the most disciplined. And discipline comes from building rules you trust enough to follow every time. Now let's pause for a minute. I've shared the playbook the masters use, but the real question is, how do you trade? Be honest with yourself. Do you cut your losers quickly? Or do you rationalize them and hope they bounce? Are you holding too many stocks at once, spreading your attention so thin that you can't focus? When you look at your charts, are they clean and simple, or cluttered with so many indicators that you're paralyzed instead of decisive? Do you stick with your strategy through rough patches, or do you drift into something new every time you hit a losing streak? Here's the toughest one. Are you truly trading your plan, or are you just improvising with money? These questions aren't meant to discourage you. They're meant to surface the habits that quietly drain your confidence. Because the difference between the average trader and the masters isn't intelligence, it's awareness. It's the ability to see your own traps before they spring shut. So take a moment, write these questions down. Be brutally honest with your answers. Because clarity here is worth more than any hot stock pick. If you've made it this far, you already know, the real battle in trading isn't on the chart, it's in your mind. So here's my challenge for you. Take one rule from today's talk, whether it's write your stop before your entry or move money from losers to winners, and put it into practice this week. Don't just think about it, write it down, trade it, live it. Then drop a comment below and tell me which rule you're committing to. Because when you write it publicly, you hold yourself accountable. And you might inspire another trader who's struggling with the same thing. If you found value here, share this video with a friend who's stuck in the same cycle. Hit like. Subscribe. It's the simplest way to support this channel, and it helps get this message out to more traders who need it. And before you go, check out the videos on the end screen. Each one is designed to build on what you learned today, so you don't just stop here. You keep stacking edges and strengthening your mindset. Remember this, The average trader loses not because they can't find winners, but because they sabotage themselves. Don't let that be you. Master your mind. Master the market. Trade with confidence and live with calm.